afternoon. My name is Kent Skornia, President and CEO of Krilogy, and I'm here with my partner, John McArthur, our Chief Investment Officer here at Krilogy, and this is your November market perspective. Johnny, let's get right into it. Let's talk big picture. Obviously, we had an election. That's going to now flip to what's the economy look like, how do the markets look, and then what should our clients be considering as we move forward going into the new year?
Lower probability outcome, but certainly something we talked about as being possible, a Republican sweep. And, I think there's a lot of optimism around less regulation, lower taxes, policies to promote growth in the economic system. I think when we look at the economy and where things stand now, I think a lot of the fiscal spending that's driven a lot up until this point has really put things, economically speaking, on firm footing, generally speaking, whether it's the consumer side with retail sales and overall household net worth, whether it's manufacturing, services, housing's a little bit mixed. Inflation is firming, but certainly coming down. So I think economically speaking, there's reason for optimism here as we look into 2025.
And you and I speak to a lot of business owners, executives who are owning, operating, controlling companies and running strategy for companies. Now that there has been a Republican sweep, you can hear that in the tone of their voices saying, okay, well, at least we know the rules of the game going forward in the general, right? And there's a little bit more confidence from the decisions they're going to make now that they have an answer to the election.
That's the key point. It's the certainty of the outcome, that the cloud and the overhang and uncertainty around what the administration looks like and what policies are put in place or discussed about being put in place. That is very mainstream at the moment. I take Scott Bessent as the new Treasury Secretary, his 333 initiative, 3% GDP, 3 million barrels of additional oil produced daily, and then budget deficit 3% of GDP. It's closer to 7 now.
Yep.
I think the question is what near-term pain has to happen in order for us to get there. Again, as mentioned, fiscal spending has been a big driver of a lot. How much growth, productivity can result when the government theoretically pulls back the spending reins. But to be clear, the government needs lower rates.
Needs to happen. Is it going to happen? What's how's the economy going to react and how do the markets react? We've seen the Trump bump here really take off, a 7% return in November. We're at 2 years now. The S&P 500 is over 20% for the year. The positive, that's 2 years in a row. That hasn't happened since the 90s.
Right.
So this is a unique time in the markets.
It is. I think investors need to, just as one needs to kind of keep their cool in moments of volatility to the downside, I would argue that that's just as important now. I think, you're seeing in some instances this exuberant animal spirits of sorts, and one needs to just really stick to process, stay disciplined, not let emotion dictate behavior.
Yep. And I feel like we say that every time here, right? And it's stick to the process. Let's not let emotion take over. What are you seeing on the portfolio side? And as we narrow down to the markets now to the portfolio pieces, what kind of adjustments have you made? Yeah. Are you looking to make? Yeah. Or that you might anticipate going down the road?
Yeah, we've talked about fixed income quite a bit in the past. I think from an expected returns perspective on a longer term basis, 3 to 5 years plus, from a risk reward perspective, I think fixed income in certain segments of the bond market looks attractive. Obviously, investors it's easy to focus on how great equity returns have been. I would just remind folks you're paying a pretty expensive price for future earnings at the moment. There needs to be a lot of follow through from an earnings perspective. We've seen significant multiple expansion. And as we've talked about, earnings need to follow through. They've been fine, but again, they're expensive historically speaking. I think from a portfolio perspective, we're well aware that we're in a new era of rates and inflation and a lot of volatility within rates and inflation. If we go back to the global financial crisis, really through 2022, we saw the 10-year Treasury yield get as low as 0.5%, up to 3.5 to 3.75. When the Fed hiked as much as they did in the 2022-2023 period, we're now in an era having broken that 40-year bull market in bonds, and I think it's right to expect a higher rate, higher inflationary environment for a longer period of time, which means, generally speaking, that real assets, commodities, from a secular basis, are interesting as we look at portfolio positioning and exposures really that we haven't participated in to a really significant degree, historically speaking.
And it's interesting because you and I were speaking earlier this summer that potentially we could see rate cuts into June of next year. Now, all of a sudden, the trend has changed that, we may not see too many rate cuts going forward, maybe a couple here or there, but not too long. And the reason for that may being that the Fed might need some rate cuts in their back pocket in case something turns to the negative in terms of the economy.
Absolutely. It's a really good point. I mean, I think it's right to expect probably another 25 basis point cut in December, later in December. But beyond that, it's anyone's guess. The market's priced in a lot less. At one point in time, it was as many as 6 more. I think that's come down quite a bit. So the bond market is less certain that the inflation war is over. So maintaining diversification, both within equities and fixed income, and thinking about real assets, commodities, exposure to the extent that you're not participating there is probably wise to further explore.
And this is a busy time for you and your team. Not only the portfolio strategy team as you're wrapping up 2024, but looking into 2025. Also for your trading team, you're doing a lot of tax loss harvesting, looking at portfolios in terms of opportunities to take advantage of. Talk to us about what's happening with the team.
Yeah, the tactical work is really important from a rebalance perspective, taking advantage of any pockets that losses exist in. Certainly, this has not been a year where there have been many, but to the extent that one can realize losses having process in a disciplined way, such as the way that our team has built that is really effective for folks. And December's a pretty popular month to kind of
a great time to take advantage of the opportunity. And that would be my final statement for today. It's December 2nd. As you're looking into the final part of the year, you are, as everyone gets busy, their lives get more hectic. It feels like more holiday opportunities are coming about in terms of, socially, what have you. But I would challenge you to do this. Take a look at your financial plan, have a conversation with your financial advisors, and make sure that you're set up, particularly on your tax side. We have Krilogy tax services here at Krilogy that we want to help make sure that our clients are looking forward into 2025, but taking advantage of opportunities right now in 2024. So just to have a conversation with your advisor about your personal tax situation, I think you can find that there's a great opportunity to save some money in 2024 tax year. And then also in the year end, a lot of people think about their estate plan. Krilogy Law, our affiliated law firm here at Krilogy, led by Deb Smiley, does such a great job of reviewing our clients' estate plan to make sure that as they go into 2025 and they wanted to make sure they had all of their ducks in a row, so to speak, that they can tidy those things up as you go to the year end. So for John McArthur, I'm Kent Skornia. We really appreciate your time today. As always, we thank you for allowing us to be stewards of your wealth. Thank you very much and have a wonderful afternoon.